Sure, that sounds great. Hi, everyone. Welcome. I am going to start by introducing John Carvalho from Stone Oak Capital and Divestopedia. Tell us a bit about yourself, John.
Hi, everybody. Great to be here, and thanks for the opportunity to come and join you guys. Yeah, so I guess I'll give a little bit of my background. Professionally, I started off as a chartered accountant, worked at Deloitte and Touche. I still call it Deloitte and Touche. You can tell how old I am by calling it Deloitte and Touche. I was in their corporate finance group for about 10 years, working on buy side, sell side engagements. And it was there that I really kind of fell in love with doing deals. Mark Twain said, the two most important days of your life are the day that you're born and the day you find out why. And, it was there. And on doing a deal, we actually closed in October of 2008, right after the financial crisis had happened. We closed this deal for this entrepreneur. And it was then that I realized just how important the work that I was doing was, and it really just drove my passion for being a deal maker and helping people facilitate deals. Fast forward to 2010, I left Deloitte. I kind of had this entrepreneurial bug that I wanted to pursue. Started an M&A advisory practice, didn't have any clients, but knew that I was going to work hard to find some. Had the good fortune of running into some amazing entrepreneurs that I partnered with. One was Corey Jansen. Some people might know him in the Alberta community of starting Investopedia and also starting Alta ML now. He and I built a website called Divestopedia. It was around educating entrepreneurs on middle market M&A. There's just this lack of information, and Village Wealth is doing the same in terms of really educating entrepreneurs on buying and selling businesses. And I wanted to do that through Divestopedia. And then, as luck would have it, I ran into another incredible entrepreneur called Jesse Douglas. He and I started off as kind of like a client advisor, where I was helping him buy a business. And as we worked a little bit closer together, we formed a friendship and a partnership and bought a business together. And before I knew it, we had bought 17 businesses, and we were $240 million in revenue, 1,000 employees, and we took it public in 2019. So that experience really showed me the power and the transformative nature of being able to go out and do a whole bunch of acquisitions to grow a business. So right now I'm focused on Divestopedia and kind of refocused again on kind of a merger and acquisition advisory firm that I call Stone Oak. So that's my story. Thanks again for the opportunity to be here.
Thanks, John. Next, we'll move on to Alina Martin from BDC. You're muted.
You think after all this time, I'd be used to the mute button. Anyway, thanks everybody for having me today. I chunk my career really in the last 20 years into sort of two pieces. The first piece is I've been an entrepreneur my entire career, built and sold businesses. I was co-founder of a safety business called Danatech Educational Services here in Alberta. That's where I really got my sort of acquisition mindset underneath my feet, did a lot of acquisitions in that business, eventually sold it to a company called Yardstick Testing and Training, and then joined them for 4 years doing more M&A growth in regulated spaces. I had the fortunate opportunity in 2019 to sell. And so I took that. And since then, I've been doing a variety of things. Sort of do three things. One is sort of my day role with BDC. So I help entrepreneurs where they get to a plateau in their business. As soon as they get to that plateau, we help them get to the next stage of growth. So it's really working boots on the ground. So work with several companies across Canada. I was just in Vancouver last week working with a great tech company there and really helping them grow. It's really what we're focused on, and acquisitions are always part of that strategy. The second thing I do is my family office. So we make investments in local tech entrepreneurs, really love the startup community. I'm highly active there, love technology, anything especially that's disruptive. in anything that's sort of regulated attached to that, I really like. And then the third thing I do, I've got lots of startups and lots of other businesses, whether that's in real estate or new business helping my husband with. So just well-rounded, I'm always on both sides of the coin, whether that's helping companies grow, whether that's building stuff for myself or investing in the local ecosystem here.
Awesome. Thanks so much, Alina. And next on our panel is Zafar Jaffer from Gowlings. Tell us a bit about yourself.
Yeah, so my name is Zafar Jaffer. I'm a partner at Gowling WLG in Calgary. We're an international firm with over 1,500 lawyers globally. I myself practice in our corporate finance and M&A group. Have experience in both public and private M&A, including cross-border and international deals, assisting clients with capital raising, deal structuring, and transactions of all types. Although I'm the head of our technology group, my practice is very industry agnostic, and we work with clients and advise clients of all types and sizes, including startups to multinationals across our platform. But my claim to fame is being the co-chair of the Calgary chapter of the M&A Club, because I do that with Liz, and Liz makes me look good on a weekly basis. But thank you for your time today and joining us, and I look forward to the conversation.
Great. Thanks so much, guys. So let's just dive right in. Liz has prepared a bunch of questions for us today. So let's start with why did you choose to start growing through acquisition? Maybe we start with you, John.
Sure. Yeah. And I don't think it was necessarily a choice that I had. Like I knew that I wanted to get into being an operator of a business versus just being an advisor. So, I felt I had the skills to go out and find opportunities, structure transactions. I was good at kind of understanding the price, financing, all of that. But it was really kind of the initiative of my partner who wanted to grow through acquisitions. So I was a facilitator of that. I was really good at finding deals, structuring deals, closing deals. He was really good at operating the business. He had a lot of financial skill as well. So, I think we did that first acquisition, and as I said before, it was before I knew it that we had bought a whole bunch of other businesses. So it became kind of like this snowball rolling down the hill, just getting bigger and bigger and bigger, where I started to believe that we could double, triple, quadruple this business in a lot shorter time frame by going out and acquiring really good businesses. So for me, the belief built over time. It wasn't something that I was really kind of focused on and saying, okay, I'm going to go out and kind of consolidate this industry. So
Awesome. Alina, any thoughts?
Yeah, I mean, I did my first acquisition in 2010, and I bought a competitor. And the reason I bought the competitor was to gain more market share. As my business grew, that strategy changed to enter different markets, but it originally started because we'd hit a plateau of growth. We'd grown organically for so long, and I really wanted to John's point, really sort of bolt on more acquisitions. And so I just really started getting focused on how we could make larger change instead of incremental change in our business. And so that 2010 acquisition was really pivotal for us. It really changed the trajectory of the business and really got me hooked on doing M&A, because you not only get products and services, but you get people, and it really transforms your business and can really position you to be a market kind of taker and a market leader. And that's really how I wanted to position the company at the time.
Awesome. Zafar, from your client's perspective, what drives clients to begin acquiring?
Yeah, I think very similar to the stuff that Alina and John already touched on. I think growth opportunities, ability to scale up quicker than you could if you were doing it organically. Sometimes it's a timing thing, like for synergistic targets available in the market at that time, you have to take advantage of the opportunity presents itself. So I think that's a big factor. And I think for some of our cross-border clients, a big driving factor is, especially if they're looking at targets in Canada, just the delta on Forex and the availability of capital there versus the availability of capital here to expand into a new market entirely versus just staying, in the market you already know. So I think lots of factors, but I think growth, availability of target, and the ability to kind of scale up in a quicker way, driving factors more often than not.
Okay. Probably back to Alina and John. When you guys did your first acquisition, did you feel equipped in the process? And how did you prepare in the beginning stages?
I can go first, John?
Yeah.
Sure.
Yeah.
The first acquisition I did in 2010, I was at that time was part of a group called the Women's Presidents Organization. And so I'd had the opportunity, it sort of kind of presented itself to me. I didn't really go looking for it, it kind of presented itself. So I took that opportunity and I actually put together what I thought could be the plan. And I put it in front of my women's presidents group. And I took probably an hour or two of their time and really presented the trajectory, what it would cost, what it would do to the business, what were the strategic initiatives that we could gain as a result, how could we make more money as a result of acquiring that business. And so I put it in front of them and just kind of let them beat me up, and then took a whole pile of feedback from that. And then I went out and got some advisors. So I went and got a lawyer, I went and got an accountant, and I went through and put it through their lens at the same time. And so I still feel to this day, we got a fair deal, happy with that. There was a lot of tripping. I did not understand working capital at that time, despite many people describing it to me. So that was a huge lesson. The huge lesson was working capital. But really that's how I started, was really just reaching out to my network. I don't know everything. I learn something new every day. And so I constantly have that mindset of learning, and it served me very well, but that's how I really started in my first acquisition. That's how I prepared.
That's amazing.
Yeah. For me, our first acquisition was an oil field services company. The owner was 78 years old, and the day we purchased it, I remember it. He came up to us. He literally gave us the keys. Jumped into his 1990 Cadillac and drove to the airport because he had a home in Phoenix, and he was there for the next 6 months. He said, "Hey, if you need me, give me a call. I might pick up, I might not, but here's my number." So it was it was kind of like baptism by fire, where we went in and there was an existing management team in the business, and not that we overestimated their skills, but we had thought that they were a little bit more involved in some aspects of the business that they and quickly realized that they weren't. So we had to kind of take those up. The accounting was an absolute disaster and a mess. So, was I prepared for all of the challenges? No, definitely not. We just kind of rolled up our sleeves and got in there and did what we had to do to make sure that the business kind of continued to operate and continue to run as we wanted it to. So, and as we did more and more acquisitions, we definitely got better. We kind of analyzed the mistakes that we made in that first one, and we tried to minimize those mistakes in the second one, or kind of find ways to mitigate that risk. And we had some different ways of doing that.
That being said, so what did you do differently in subsequent acquisitions from your first?
Yeah, great question. I think a couple of things that we did is we changed the structure up a bit. So rather than us buying a company entirely, where again the existing owner is just giving us the keys and walking away, we tried to structure transactions that had an existing management team, and then our acquisition process included those managers in taking some equity of a bigger entity. So that was one of the big changes that we did. So we started to build our management team through acquisition. So, your first question was why did we do the acquisitions? And there's different reasons why we did acquisitions as we went along. And that structure really helped us facilitate and continue our growth and deepen our management team. So not only were we acquiring businesses, but we were acquiring managers in different geographical regions.
Alina?
Yeah, we always talk about the art of the deal a lot. And the deal is fun. I love the deal. I love putting the deal together. I think what I learned very quickly was that the integration of the deal is really, well, it's key. It's key to success. So, we made a lot of mistakes along the way, integrating deals. We did multiple transactions. And so there's a lot to be said about how you integrate. John touched on it a little bit, what managers you're bringing along, how you're positioning them. I think I took for granted initially, the cultural implications of one entity to another and how you mix those cultures together. There's a really great book called Five Frogs on a Log. And after about my third transaction, I thought, man, I got to get this integration portion thing figured out. And so I think they have 7 deadly sins in that book of M&A, and I've committed all of them. And so I think that there's a lot to be said on the integration side. And that's where we don't spend enough time. We talk a lot about, how much is the value of that business worth? What are the synergies that we will gain as a result of that? But I really focus now on what do we do once we get it? Right? Because there's a time frame where you can see value in that transaction, and there is a time frame where that value is lost. So it's spending a little bit more time on that integration portion. So I would say I learned that lesson the hard way.
Maybe I'll add to that. Like, I also think though, the type of acquirer that you are kind of really dictates what type of integration.
That's a great point. Yeah.
So we were buying businesses that had the existing management team, so they didn't really have to change anything operationally. But what we wanted to do is we wanted to take some of the back end processes, like the accounting, the finance, some of the sales and marketing. We wanted to kind of integrate into a bigger entity. So it's thinking through, not only, hey, I have to integrate this business, but how do you want to acquire this business, and what are the areas that you need to focus on in integration? I think was important for us.
Yeah, that's a really good point, because I think one of the things we did is we typically took out the management team. And so that can create a lot of instability in the organization. And I learned that early on. So I think it's a really good point. You ask yourself, what kind of acquirer am I? Do I want to lead this business? Do I not want to lead this business? Do I maybe want to do an asset buy instead of a share buy, right? Those are certain considerations that I think set up the internal metrics too at the end.
And I think
we made a lot of mistakes, just to be clear,
Yeah,
I
totally. I get it.
What the 7 deadly sins are, but I'm sure I can add a few to those. So
yeah, totally.
I'm going to try and, Zafar was just going to jump in. I think he had something to say.
I think, yeah, I mean, integration is definitely an important factor. I think focusing on the deal itself, I mean, everyone can acknowledge that it's a stressful time, like whether you're the acquirer or the target being acquired. The importance of having an advisor team, I think Alina and John will both, say that adds a lot of value, and to get advisors involved at an earlier stage of the acquisition time frame is better. Saves a lot of time and money on the back end. But I think one of the things to consider is also, and I think this is something that you learn over doing multiple transactions, is assessing critically the readiness of the target to be acquired. Because if the target, people want to sell, but if the company's not ready to be sold because their books and records are a mess or whatever the case may be, that can add a lot of delay in the deal flow and drag out the transaction. You get into deal fatigue after a couple months of doing due diligence and all that other stuff. So being able to more critically assess what the exit ramps are for you throughout the negotiation, so that you're not just spinning your wheels or wasting a bunch of time and frankly money on a target that's just not ready to be acquired, that then will impact what Alina and John have touched on the back end is post-closing on the integration. So having all that stuff lined up is important, and I think you get more critical at assessing that, because it's hard. You spent money doing the NDA, and you spent money doing the LOI, and you spent money starting to do due diligence. It's really hard to walk away from a deal at that point, but sometimes the best deals are the ones that you don't make. So
thanks for that, Zafar. How am I coming through now?
Good.
Perfect. I'm going to try and jump back in here. Thanks, Giselle.
Yeah, of course.
Well, back to you, John. So, and pulling off of Zafir's last comment about the due diligence and not, being really sure when you want to continue to move through this deal and having the right advisors at the table. John, what, in your opinion, what's the biggest challenge with M&A and acquisitions?
Can I only pick one, or?
Start
We
with
could be
one,
here all
and
day.
we'll go from there.
Yeah. Yeah, I think all of it's challenging, and I think, we'll probably talk about this, as we continue the discussion here, but I think a lot of people find obstacles at different phases of, of the acquisition process. I think finding deals is hard, finding opportunities, really creating that flywheel of having, being able to source deals and source opportunities is tough for some people. Other people, it's the financing, right? Like, how do you finance? Other people, it's the valuation. How do I structure a deal? How do I make sure that I'm paying the right price, but balancing that off with, cash up front with maybe some earnouts on the back end. And other people, as Zafir had talked about, due diligence is difficult, right? Like, you're seeing all of these obstacles and all of these risks, right? How do you mitigate those risks, or how do you put in place, more certainty around the transaction to make sure that it doesn't implode on day one after you've spent, tens of millions of dollars on it. So, sorry, you asked me for one and I've given you, 10 here, but I think there are different challenges at different phases of actually trying to do an acquisition.
Absolutely. So it sounds like challenges across the board.
Yeah.
Alina, of that swath of challenges, where would you lean in?
It's a good question, and John just sort of touched on it. It's a big, wide topic. I would say one of the things is about readiness, is about determining whether or not your organization is actually ready. I talked a lot to entrepreneurs, and they want to acquire a business to get into a new market, but are they set up? Do they have the infrastructure in order to execute well? Because the moment that you layer something else on, you're just creating more complexity. So I think there's other things that you need to think about if you're an existing organization and you're bringing something in. Alternatively, it's a great opportunity for a solo entrepreneur to get into a business, right? By acquiring a business, and you have to do a really good job of sort of measuring the risks and all the touch points that sort of John put on. But it's a multifaceted question, because I don't think there's one sort of difficult point. I think it depends where you are in the trajectory of what you're trying to accomplish.
Yeah, absolutely. I'm going to pull on something that you said is, looking at the readiness of your own company and how you're going to manage that. I'm going to take what you said and I'm going to throw it to Zafir for what he sees when clients are going through acquisitions. Is he seeing that, are they just kind of trying to do it off the side of their desks, or some people, allocate one person within the company to start managing the acquisition strategy? Zafir, what are you seeing?
Yeah, I mean, I think it's, again, to John's point earlier, it depends on the type of acquirer you are. I think that plays a big role in how an acquiring company sets themselves up for M&A deals. But I think having a deal team and having people that are dedicated to reviewing the due diligence, understanding your business and the target's business, you need people that are really invested in it. It's not something that you should or could be doing off the side of your desk. If you do it like that, it causes unnecessary delays. You're going to miss stuff, or you're going to spend a lot more money on your advisors because you're going to rely more heavily on them to do the work that you could and potentially should be doing. And at the end of the day, you could have the best accounting team, legal team, banking team behind you, but they don't know the nitty-gritty of your business, and they're not going to know the nuances of the target. So that stuff, like those soft intangibles like culture fit and those types of things, those are important considerations that only someone at the acquirer is going to be able to properly assess. But I think in addition to that, some of the other challenges, there's obviously challenges around valuation, and in our current climate, financing interest rates and then in Canada, of course, Forex is always a factor as well. There's always going to be fights about indemnities and tax and whether it should be a share purchase or an asset purchase deal. But I think one thing that we often see that gets missed that or doesn't get enough consideration, at least early on at the LOI stage, is how you're going to treat the employees of the business. So, generally speaking, most companies will have a bunch of employees that you're going to either want or not want. Get into fights later on around severance considerations and who's going to pay what and who you want to transfer and who you don't. And a company that's had long-standing employees for a number of years that you want to come over, or you don't want to come over, or once they come over, they're not a fit and you have to let them go. You want to make sure that the agreement deals with how the severance obligations will be dealt with. I think that's one that often gets overlooked and missed, because those can be material if the employment agreement isn't set up to limit what termination pay is going to be and things of that nature. So the last thing you want to do is have someone that's been around for 20 years join you, and 6 months later you realize it's not a fit and you want to let them go, but now you have to pay them severance obligation of 20 years that you really didn't get to enjoy the benefit of that service.
Alina, John, any comments in response to Zafar?
Yeah, I have one, and he touched on an important point in terms of not just doing this off of the side of someone's desk, right? I think if you want to pursue an acquisitive growth strategy, I think it needs to be the strategy that you're pursuing, right? If you say, hey, I want to go out and I want to be an acquirer, then you have to build like a team around that, and internally and also externally, right, with the advisors and the professionals that are going to help facilitate this. So, what I see often, it's like sometimes opportunistic. An opportunity comes to you, and you start to assess it. But really, the people that succeed at this are the ones that have built this into their growth. Have built this into, this is how I want to build my business, and actually going out and acquiring. And then the second really important point that I'll add to that is this needs to be a C-suite activity, right? It can't just be, I'm going to give this to an analyst and he's going to go out and find some deals and put some offers out. I think it needs to be led by the CEO of the business. So I think they have to have a really important role in, kind of pushing these transactions that can move forward and closing these opportunities.
Great point. Alina, anything to add on that thread?
No, nothing that hasn't already been said. I'll just talk to deal flow a little bit versus opportunistic versus strategic. I think that's a really important point. Sometimes there are deals that land on your desk that are just pure opportunistic deals. But longer term and more successful strategy that is driving towards that as a growth avenue, I think is a much better approach to sort of M&A instead of sort of that ad hoc. I think if you're just getting started, that you got to really think about, if you're going to acquire a business, what the future of that business looks like. Are you a lifestyle entrepreneur or not? Are you going to buy a business and just operate it? Do you want to be the operator, or is this a much bigger play? And I think sometimes people just don't think big enough, right? If you're going to enter an industry, let's just say it's a construction industry, and you're going to buy a small construction company. Well, how do you grow into other markets, right? You've got to look at these other things instead of sort of looking at it very narrowly. I choose to look at them very broadly. And I think as an entrepreneur, if you're going to acquire a business, I think you really need to understand what kind of entrepreneur you are and how you want to grow that business long term, so that you see the value out of that transaction.
Perfect. That leads into our next question perfectly, Alina. So when you guys eventually had your exits, you and John, how did your acquisition history play a part in that? Selling your company versus in itself versus having gone through the acquisitions that you did. How did that add to the equation?
Maybe I'll just go first. I'll just touch on it lightly. I think once you start to do deals and you start to understand the structure of deals and you understand some of the points where you can pull and where you can push. I think ultimately when I had my exit in 2019, I really understood what I was willing to sort of let the gas up on. I didn't need to press down on, and where I knew I needed to push from a negotiation standpoint. And that was really helpful because it saved a ton of lawyers' fees because I'd learned all those lessons, right? The previous 10 years. And so that's a really important point. I just closed a deal a couple of months ago, and it was a really clean asset deal. And so you just, once you start going through these things, you just really know the levers to pull. And I think that's really important. That's why it's important to talk to people that have the expertise and say, you know what, maybe you should look here. That might not be as much of an important point of the deal as you think it is. And here are the reasons why. And so it's asking really great questions and being open.
Yeah, and I love how when you did your first acquisition, you said you brought it to your business group, and you'd never done it before, and you asked for mentorship. And I think John can attest to that. Every transaction, every deal, every acquisition is unique, and there's tidbits to learn from each one. So even in your own exit, where you had learned a lot about the process itself because of all of your own acquisitions, it was still different, but it gave you that much more.
Every deal is different. They all have nuances to them. All have nuances.
Yeah. John, what about yourself there? How did, the journey of your acquisition path impact ultimately your sale?
Yeah, so we went public in 2019, not to create liquidity for the shareholders, but to access capital for continued growth. So we kind of, capped out the debt markets, and we wanted to kind of get into the public realm to now start to access institutional investors. So didn't have liquidity there. I'm still a pretty significant shareholder in Wolverine, but I mean, that taught me a lot, actually. So I've never really kind of done a lot of work in the public markets. So taking a company public through a reverse takeover was definitely, a journey and an experience, kind of drinking out of a fire hose there and working through that. It helped me, it gave me perspective on, what the dynamics are in terms of valuation for the public markets, which are a little bit different than the private markets. Like obviously the private markets are very kind of opaque, where there should be more transparency and more kind of access to information in the public markets, which should make valuations a little bit more fair. Should be more fair market value, just given the more transparency there. It's not always the case, but and then it taught me a little bit about patience, right? Just how hard it is to get liquidity in a private business. So it just made me a little bit more patient in terms of finding the spots to get liquidity for myself, and knowing that things don't happen overnight. Like a lot of different factors and a lot of different variables have to come together for there to be value creation and to create liquidity.
Thanks for that context there, John. I'm going to pivot here and we'll go pretty quick through the last questions. We want to leave some time for audience questions that we do see them in the chat. So we are watching. We'll leave about 10 minutes at the end for audience questions. So if you've got some percolating, think about them. You can plant them in the chat and we'll pull a few. But back to you, Alina, and then we'll leave this one for Zafar as well. What holds companies back from pursuing M&A, in your opinion?
Oh, that's a great question. I think the reason is different for every CEO or entrepreneur, but I see lack of knowledge and a bit of fear. I think people just don't know, right? They just don't know. They may not know somebody that's done some acquired growth, especially in the private markets. It's usually private. You don't know what to value a business at, or how you're valuing a business, or where you go and find, an acquired target. And so some of the strategies that I deployed when I was a CEO and I was in a private company trying to determine how to grow, and I just didn't know, was I just started asking questions, started talking to people, and really started to dig in. And then that fear sort of goes away a little bit. And, I once bought this electrical engineering firm. It was one of the best transactions I did. And I really thought that my business could grow very aggressively in this new market. And so they were all private companies, you know, and they were all little and they were all run by entrepreneurs. And so I literally just got to know people. I called, I asked, you know, people say, well, how do you acquire these private businesses? You can pick up the phone. You know, I picked up the phone and called in probably 2012, my biggest competitor in Ontario. And I asked him if he wanted to sell his business to me. I just picked up the phone and I asked him, and you'd be surprised. People can only say no. And so a lot of the time I see fear and just sort of lack of knowledge preventing people from moving forward in that strategy on the private side.
Yeah, very true. We see a lot of that too. And it's kind of flexing those muscles and building those muscles of confidence in this to just have more conversations, you know, get out for coffee with more people who have done it before, ask in your network. Even if people are wondering, well, how do I find someone who has acquired before? You know, you've got relationships with your banker and your lawyer and your accountant already.
Yep.
They know people who have made acquisitions. They'd be happy to introduce you to other people in their network who have made acquisitions before. So I'm going to jump to John. John, what about you? What holds people back from pursuing M&A?
Yeah, I mean, Alina's answer was so perfect. You know, those are the two real reasons, right? It's lack of information and fear. You know, for me, my partner Jesse, I mean, he was fearless. You know, not reckless, but fearless. Like I remember us doing I think it was our second or third acquisition that would have, like, the acquisition that we did would have doubled our business. So it was like, you know, small business actually buying a business that was like double our size. And, you know, we went to the bank and he was kind of showing the forecast of like, okay, we're, you know, 10 million now, in 3 years, we're going to be 50 million. And there's a disbelief, like you go into the bank and the banker is like, there's no way you're going to get to 50 million. Like this isn't normal. This isn't what, you know, how people grow their businesses. Right. And then we walked out of that meeting and Jesse turns to me and he says, I'm sure glad I didn't show him the real forecast of getting to 100 million. You know, it's just true. I mean, that's the mindset that he had, is just like, we're going to do this. And there's like, you know, there's going to be lots of hiccups and there's going to be lots of obstacles that we're going to encounter. But he went at it from a mindset of fearlessness and, you know, and also kind of like getting the necessary information. So we weren't reckless, right? So, you know, mitigating that risk, creating a little bit more certainty around, you know, if things go wrong, what are we going to do? What's plan A, B, and C? That we're going to kind of mitigate that risk around, you know, these big risk areas within that we're seeing in due diligence.
I like that. I like Jesse's story of like thinking big, and it ties into what Alina said too about, you know, maybe you're not thinking big enough, but at the same time, as Zafar had said, you know, make sure you've got your people, make sure you've got your advisor team, because you can have the visionary in the company, but then you've also got to have the one who's, you know, the realist as well, and having all those personalities on your teams and at play is like, think big, but protect yourself and make good decisions. Zafar, what about you? What's holding people back from pursuing M&A in what you're seeing and what your clients are saying these days?
Yeah, I mean, I think obviously John and Alina touched on the fear thing and the knowledge thing, which is two of the key things. I think one of the other things is cost. And I think that comes into play because I think people need to understand, like, especially when you're buying, you know, smaller businesses, it's a really personal thing for the seller. Sometimes these people, they've built this from the ground up. It's been their source of livelihood for 30, 40 years. This is how they've, you know, put a roof over their heads, raised a family, built a life here. It's really hard to separate from that. It's a part of your being and your identity. So as a buyer, understanding that, appreciating, you know, the emotional component around that and the sensitivities is important. It makes for a lot smoother of a process when you can kind of meet them where they are and have that conversation at that level, because these employees become like family to them too. So how are they going to be treated? What's important to them needs to be what's important to you. Or you need to at least acknowledge that you get it. You're not just some, deal junkie that wants to come in and strip it for its parts or whatever the case is. And then I think thinking creatively, the solution to that is just thinking creatively enough about bridging the gap on those key terms, earnouts, transitioning between, the current ownership group and the incoming ownership group, creative ways to finance the deal, but giving those sellers some understanding of what's going to happen post closing will remove a lot of those fears. Because then they'll feel more comfortable that what they've worked so hard to build isn't just going to disappear post closing. So I think those things are important.
I'll just add to that, Zafar. I agree with the being empathetic and recognizing that the seller, this is their baby that they've built over years and years and years. But for us, we wanted to acquire businesses, so we needed to see quickly if a seller was motivated and realistic about what a transaction looked like. So we really got from the point that we made an introduction to, we were introduced to a potential opportunity to the point of us getting an LOI. It was like 2 weeks to a month, right? It was really quick. And that became our, basis to have deeper conversations, but it also became the basis for us to kind of suss out entrepreneurs that were just, not really understanding what a fair transaction looked like. So, trying to balance empathy for sure, but also trying to, really kind of accelerate and move forward with our strategy to find out, okay, who's real in terms of wanting to kind of transact and be acquired.
And readiness of the seller. This is a bit of an off the cuff question. This is unplanned, but any tips for assessing the readiness of a seller? Like if they're not on market, maybe you've gone to them directly and said, hey, are you willing to sell your business? Any tips for like understanding whether they're ready or not? Or like sometimes you don't find out till later on in the deal, and we've had members of Village Wealth have that happen. Any tips for kind of
put an offer, like just make an offer, right, of something that's fair, and see how they react, see how they negotiate it, and but most time we've found that entrepreneurs and most people keep their word, right? So if they're going to sign an LOI, it's something that they're committed to, and something that they'll see through. So and that's where costs start to build up too, right? As soon as you get an LOI signed, usually engaging a lawyer, you're getting your employees to gather due diligence information, so that their actions start to show that they're ready.
Yeah, and at that point they're spending money.
Yeah.
We'll jump over. We want to leave time for questions from the group here. So we've got one on valuation from Rob here. Do you find deal valuations are lower during recessionary times versus periods of higher economic growth? So Alina or John, either of you want to take that one first?
I'd love to hear what, I can certainly ask. I'd love to hear your feedback too, John. I would say yes and no. So for me, the deals that I've done and what I've seen are not necessarily tied to what's happening in the public market. But if you are in a business that is tied to some sort of recessionary market and it is a private market, then yes, the valuation of that business is down. But if you are in a growing market, and sorry, my dog is just loving me over here. If you're in a growing market, then what's happening? Sorry, he got me off of my. He's sitting here. He got me off of my thought pattern. So two things. One, let me just go back on that. One, yes and no. If there are things going on in the recessionary market and you are in a recessionary business and you don't have any aggressive growth plans, there isn't anything to really buy, then yes, the valuation of that business is down. But not all businesses run with recessionary markets. So it depends what it is, where it is, and where it's positioned. What kind of acquisition is it? Is it a strategic acquisition? Is it a bailout acquisition? What kind of acquisition is it? Also determines the valuation of that.
So many factors. John,
Yep.
what's your opinion? Oh, and Rob wants to see your dog, Alina.
Oh,
Alina's really smart. I mean, what she just said is bang on. I think it really depends on the business. I think the one factor that does impact it is, you know, in a recessionary environment, access to capital is tougher, interest rates are higher. So, you know, it's just turns out that, you know, the amount of money that you can get as an acquirer to buy a business is either tougher to get or it costs more, right? So that has a real impact on valuations. I will add that what happens in a recessionary environment, again, dependent on the business. So growing business, I think the valuations stay the same. But what would happen would be deal terms. So there's just more uncertainty in terms of like where kind of the markets are going. You know, then you might see more things like an earnout. Things that are contingent on the results of the business. So, you know, that's where I would see a little bit of a difference, maybe not necessarily on valuation, but more on deal terms.
yeah, that's a good point, John, right? And cost of capital too, right now, very, very different, you know, depending on the economy and what you're buying and how you're buying it. That's always a factor in the earnout portion as well. Yeah.
Yeah. And that can change who your buyer type is too. Like if your buyer absolutely needs to leverage debt versus a buyer who has deeper pockets and can pull some different levers, that can change too. Question here. Another one. Do you find business owners always overvalue their business? How do you bridge the gap between what's fair and what they're dreaming? Alina, do you want to take that one first?
Sure, happy to add some color. A lot of the time, if it depends how wide the gap is. So first and foremost, how big is the gap? Secondly, I have, and this is just my personal experience. So I have found if the gap is too big, they're typically not ready to sell, or they're not realistic. And you can't get into a good negotiation. It typically isn't a good transaction. And I've walked away from some transactions that you just can't get the value to the place that you need it. And so it has to, I always believe that the deal has to feel fair to both parties. And so if the gap is too big and you can't overcome it, then you can't overcome it. And it's better to know that quickly. So I really agree with John that, you know, get to an LOI really, really quickly, get to know the CEO entrepreneur very quickly, get to understand what's driving their decision to sell, and do it very fast.
Yeah, perfect. Zafar, anything to add on that one before I go to John? Evaluation.
I think one thing to think about is, and I think Alina can speak to this too, but I think it's really easy to tell when someone's a tire kicker. You know, and sometimes you know that from the fact that it's clear that they're, you know, trying to hit a home run on the business. And I think if you could take it back to the actual numbers on the page and explain the rationale of, you know, the offer that you're coming up with, it gets really hard to argue against that. So as long as you can take a defensible position with the offer, if they're not willing to accept that, if you can't agree when you know you're putting forward a market offer, that's a sign of things to come anyway. So you can't agree on, you know, the stuff that you think is pretty much evident in the numbers. It's not going to be smooth sailing in terms of the negotiation on the finer points going forward. So I think that if you're able to kind of bridge the gap there through looking at the financials, you know, that's a good indication of how the deal flow will transition from that point forward.
John, opinions on settling seller expectations?
Yeah, I guess I'll say yes. Entrepreneurs always overvalue their business. You know, that I'll just put that very broad generality out there. You know, no, in all seriousness, like I back to Alina's point, I think, you know, getting to an LOI really quick, seeing how, you know, how big the gap is here, you know, are there different deal structures to bridge that gap? Do you want to bridge that gap in the first place, right? So I think Yeah, I mean, that's one of the biggest hurdles, I think, is this unrealistic expectation on both sides, on buyers and sellers. Like buyers always want a deal, right? I've never met a buyer that didn't want to underpay for a business. But it's, you know, it's just seeing what will get a deal done, right? And being creative on that. And I think the experience of putting out offers, this is advice for buyers that are on the calls, the experience of putting together an LOI and interacting with buyers or interacting with sellers and seeing, you know, what's acceptable, what's not acceptable, what's a fair range, like that's practice that needs to happen if you want to kind of pursue this strategy of acquisitions.
Great advice. Quick question here for you, John, from Michael. Would you say quality of earnings reports are absolutely necessary for all transactions?
Hi, Michael. I would say no. Like, we didn't do any quality of earnings. They're definitely more prevalent down in the US. And, you know, I find that due diligence is often, you know, for acquirers that are my clients right now are more predicated by the stakeholders. So the bank will say, hey, we need a quality of earnings report. So the acquirer goes out and you know, gets a $50,000 quality of earnings report. But you know, for Jesse and I, you know, I'm a financial professional. Jesse was pretty savvy and pretty sophisticated. We would always push back and we'd say, you know what, a quality of earnings isn't really necessary in this deal. And here's why. There aren't many normalizing adjustments in the transaction. And we feel these other kind of scope of due diligence that we're going to execute is way more important to this deal than, you know, a quality of earnings, right? So I think people need to take control of the due diligence rather than just being told by their stakeholders, by the bank, by their accountant saying, oh, you need a quality of earnings. You don't need a quality of earnings. You need to mitigate the risk in the transactions that you find. And, you know, there's different ways of mitigating those risks. And maybe just a quick summary, because I've thought about this lots and I don't want to just take the platform here, but I think it has to be through due diligence. Mitigating the risk can also be through looking at the operations and say, okay, what am I going to do? You know, if my manager leaves on day one, like what's my backfill on that? So if you find a risk on the operations, how are you going to mitigate that? And then the third way that you mitigate this, and Zafar can speak to this, you know, very, very in depth, is how do you mitigate this through the purchase agreement, right? What are the reps and warranties? You know, what are other sort of mechanisms in the purchase agreement that are going to like really mitigate the risks that we find in kind of, you know, navigating through this transaction?
Yeah, so much about risk mitigation and those scenarios, if this, then that, and having it all mapped out. We only have 2 minutes left. Colin, I see your question around integration. We can try and get you an answer on that through email if you want to put your email, send us a message directly. But I'm going to leave everyone with the last question to each panelist. What advice would you leave with the group in general? If you were to leave everyone with one piece of advice, what would it be? Alina, I'll start with you.
Oh, one piece of advice. I don't know if I have one piece of advice. Think big, think bigger. One thing that I see a lot on Canadian soils, we just don't think big enough here. You know, we just don't think broad enough. We just don't think big enough. You can have a really great business that is a big business. It doesn't, you know, don't be afraid of the numbers. You can acquire a big business. John talked about this earlier. You know, they were a $10 million business acquiring somebody that was going to double their business size. You can do those things. Believe that. Now you have to measure your risk, but believe. Yeah.
Awesome. Zafar.
I think the lawyer in me wants to say that, you know, have a team of advisors around you as early on in the process as possible. But I think something that would be really helpful for anyone, whether you're on the buy side or the sell side or the advisor side, is to just become a sophisticated player in the market. And one thing I highly recommend if you're considering entering into or playing in the M&A space is reading the American Bar Association annually comes out with what's called a deal point study. It's a really helpful tool to understand what is and isn't market based on industries, based on deal terms based on what you see in a purchase agreement, what to think about, and at the LOI stage. So use some of those resources, and the deal point study is a sophisticated tool that'll help you, I think, come to the market and enter the negotiation from a more equipped standpoint.
Any information you can do, so we can share that with everyone there, Zephyr, on a link to how to find that report. We are out of time, so I'm going to say goodbye to everybody if you need to jump off, but I would love to hear from John on this last question. So I'll say thank you to our panelists now, in case people are dropping off and need to go to another meeting. Thank you so much for joining us, John and Alina and Zephyr. We so appreciate it. Our next
We lost our host.
We lost our host again.
Yeah, we lost her.
I can speak to what she's speaking. We're gonna have
Am I
another.
back?
Sorry, what was that?
Am I back?
Yes, you are. There you are, Liz.
Okay. Our next webinar topic, we haven't set a date, but it is on negotiation psychology. So it'll be a great topic with some great speakers. John, question, last bit of advice you're going to let everyone.
Yeah, and this will be quick so everybody can get on with their day. But, I loved, it was a suggestion from one of the other panelists, but, just find mentorship, right? Find somebody that's done acquisitions before. There's so many things that can go wrong, and, you want to just kind of bail out at the different kind of challenges and obstacles. But if you have somebody that's been there, done that, they can help you navigate through it. So that would be my one piece of advice.
Well, technology has not been my friend today. Thank you for everyone's patience. John, I missed the last end of your question, but
it was awesome.
The session is recorded.
It was
Awesome.
It was the highlight of the whole session, wasn't it?
It was.
And I just I'll get the recording, I'm sure. Thanks, Jeff. I see you in the chat there. Thanks, John. Thanks, everybody, for joining us, and catch you at the next one.
Thank you.
Thank you.